Welcome to the Accounting Desk. In today's video, we're covering IPSAS 7, Investments in Associates. This session will guide you through the concept of associates, significant influence, the equity method, and how to reflect these investments in public sector financial statements. IPSAS 7 prescribes how to account for investments in associates, which are entities over which the investor has significant influence but not control. The standard applies to public sector entities preparing consolidated financial statements using the equity method. Let's understand a few key terms. Associate, an entity in which the investor has significant influence but not control. Significant influence, power to participate in financial and operating policy decisions, usually presumed if ownership is 20% or more. Equity method, a method of accounting whereby the investment is initially recorded at cost and adjusted thereafter for the investor's share of profit or loss. You might ask, how do we know if significant influence exists? Indicators include representation on the board, participation in policy-making processes, material transactions, interchange of managerial personnel, provision of essential technical information. While 20% or more usually implies significant influence, judgment is key. Use the equity method unless the investment is held for sale, the associate operates under severe long-term restrictions, the parent is exempt from preparing consolidated financials in rare IPSAS contexts. Remember, equity method applies only when the entity has significant influence. Let's walk through a practical example. Entity A invests in 30% of Entity B for $500,000. At year-end, Entity B earns $200,000 profit and declares dividends of $60,000. Entity A's share of profit equals 30% of $200,000, which is $60,000. The dividend received is 30% of $60,000, which amounts to $18,000. Journal entries include increasing investment by $60,000 and recording cash while reducing investment by $18,000. The net investment at year-end totals $542,000. When you acquire an associate, any difference between the cost of investment and your share of net assets is treated as goodwill. This goodwill is included in the carrying amount of the investment, not amortized, but tested for impairment. Investments in associates must be reviewed for impairment if indicators arise. Associate suffers significant losses, changes in market value, legal or operational setbacks. Impairment loss is recognized in the statement of financial performance. Entities must disclose name and nature of associate, percentage ownership, reporting date differences, summarized financial info of material associates, investment carrying amount, share of profit or loss. Transparency is key in financial reporting. In separate financial statements, investments in associates are accounted for using cost method or fair value method, depending on the policy. Equity method is not used in separate financial statements under IPSAS 7. Let's look at a public sector case. A government-owned transport agency invests in a regional joint venture company. It owns 25% and has board representation. Result, it has significant influence. Must apply equity method in consolidated accounts. In separate accounts, it uses cost method. Let's review some common mistakes. Treating all 20% ownerships as associates without checking actual influence. Forgetting to adjust for dividends under equity method. Using equity method in separate financials. Ignoring impairment testing. Practice Q1. What method is used to account for associates in consolidated statements? Practice Q. Can a 15% ownership ever qualify as an associate? Practice Q3. Where is goodwill from associate acquisition recorded? To sum up, IPSAS 7 deals with investments in associates. Use the equity method when significant influence exists. Adjust for share of profit, loss, and dividends. Disclose clearly in financials. In separate statements, use cost or fair value methods. Thanks for watching the Accounting Desk. If you found this video helpful, hit like, subscribe, and ring the bell so you never miss an update on public sector accounting standards.